If you're 54, 55, 58, if you just got laid off, or you're staring at retirement before 60 and wondering how you'll survive the gap, your first thought was probably this: my 401k is locked. I can't touch it without the IRS taking 10% off the top. I'm stuck working until 59 and a half whether I want to or not. That's what Mike thought, and it's what Tom thought too. Same company, same round of layoffs, same age, 54, both turning 55 later that year. 6 months later, one of them pulled $40,000 out of his old 401k without losing a single dollar to a penalty. The other one paid the IRS $4,000 he didn't have to pay. And he made that mistake on the exact same day almost every advisor in America tells people to make it. By the end of this video, you'll know exactly which one of those two decisions you're about to make, whether you've got $50,000 sitting in an old plan or $500,000. Here's what's coming. First, the actual rule the IRS calls the age 55 exception, and why almost nobody explains the one detail that matters most. Second, the one move, the one your financial advisor might tell you to make this week, that quietly kills your eligibility forever, permanently, the moment it happens. And third, a number you can calculate for your own situation right now, tonight, that tells you exactly how much of a bridge you'd actually need to get from here to 59 and a half. So here's what actually happened to Tom and Mike, and here's the rule underneath it. Buried in the tax code, IRC Section 72T, Congress carved out an exception to the 10% early withdrawal penalty that most people have never heard of. And the ones who have heard of it usually get one critical detail wrong. It's nicknamed the Rule of 55. Here's the plain version. If you separate from your employer, get laid off, quit, retire, whatever the reason, during or after the calendar year you turned 55, you can withdraw money directly from that specific employer's 401k or 403b plan without paying the 10% penalty. You still owe regular income tax on it, same as always, but the extra 10% the IRS normally tax on for touching retirement money early goes away completely. Notice what that rule does not say. It doesn't say you have to already be 55 on the day you separate. It says the year. Tom got laid off in March at 54 years old. He turned 55 that November. Because his separation happened in the same calendar year he turned 55, he qualified the moment his birthday passed. He didn't need to still be employed on his actual birthday, and he didn't need to wait for some special date. The year is what matters, not the date. That's the resolve to the fear you opened this video with. You are not automatically locked out of your own money until 59 and a half. If you're leaving a job in the same calendar year you turned 55, or any year after that, the door is already open. But, and this is the part that cost Mike $4,000, walking through that door correctly matters just as much as knowing it exists. Because here's the thing. Almost nobody puts in the same sentence as the Rule of 55. The single most common piece of financial advice in America is also the single fastest way to destroy it. Let's look at exactly what Mike did, because if you've got an old 401k sitting somewhere right now, you might be about to do the same thing this week. When Tom and Mike got laid off, they both did the responsible thing. They called a financial advisor. Mike's advisor told him what most advisors tell most people in this exact situation. Roll your old 401k into an IRA. You'll get more investment options, lower fees, more control over your own money. Mike signed the paperwork within 2 weeks. It felt like the smart, grown-up move, the kind of thing you tell your own kid to do. Tom's advisor happened to ask one question first. Do you think you'll need any of this money before you turn 59 and a half? Tom said, maybe. He wasn't sure how long it would take to find another job. So Tom left his money exactly where it was, sitting inside his old employer's 401k plan, and didn't roll over a dime. 5 months later, both men needed $40,000. Tom called his old plan, requested the withdrawal, and got his $40,000 minus regular income tax. No penalty at all. Mike called his IRA custodian and requested the same $40,000 from the same kind of account, holding money that used to sit in the exact same plan. And here's the part that stings. The Rule of 55 exception lives inside one specific corner of the tax code, Section 72T2AV. The carve-out written for employer plans. An IRA was never covered by it, not even a rollover IRA built entirely out of 401k money. Mike didn't just fail to use the Rule of 55 on his withdrawal. The instant that rollover cleared weeks earlier, he'd already made it permanently impossible to ever use the rule on that money again. His $40,000 withdrawal got hit with the full 10% penalty. $4,000 gone, stacked right on top of the income tax both men already owed either way. This isn't a technicality nobody actually runs into. The tax court has ruled on almost this exact mistake in a case called Watson versus Commissioner. A worker separated from his job, then tried to claim the age 55 exception on a distribution he took afterward. The court said no, because the separation itself is what triggers the exception, and once the money has moved out of the specific plan tied to that separation, the exception doesn't follow it anywhere else, no matter how similar the new account looks. So if you take away nothing else from this video, take this. Don't roll over an old 401k the moment you leave a job in or after the year you turn 55. Not until you've confirmed in writing, if you have to, that you won't need penalty-free access to that specific money before 59 and a half. Once it's out, permanently, and there's no undo button. That's the trap. But even if you avoid it completely, there are still 3 more details buried in this rule that decide whether it actually works for you the way you're picturing. And they're the parts almost every article on this topic skips entirely. First, the rule of 55 does not apply to every old 401k you've ever had in your life. It only applies to the plan connected to the employer you're separating from right now, in or after the year you turn 55. If you got a 401k sitting untouched from a job you left at 42, turning 55 this year does absolutely nothing for that specific account. It's still locked behind the regular 59.5 rule forever, unless you separately qualify some other way down the road. Only your most recent employer's plan, the one you're walking away from at 55 or later, gets the exception. Every other old account you're carrying around is untouched by anything in this video. Second, knowing the rule applies doesn't mean your specific plan will let you use it the way you're picturing. The IRS gives employers permission to allow penalty-free withdrawals after separation. It does not require them to let you take that money out in pieces. A meaningful number of 401k plans only allow a single lump sum distribution once you invoke this exception, not a slow drip you control year by year on your own schedule. If your plan works that way, pulling out $40,000 might mean pulling out all $340,000, whether you wanted to or not, and owing ordinary income tax on the entire amount in one single year. Before you count on this rule for anything, call your plan administrator directly and ask one specific question. Does this plan allow installment or partial withdrawals after separation, or only a full lump sum? Third, whatever you withdraw under the rule of 55 automatically gets 20% withheld for federal taxes before it ever reaches your bank account, whether or not that's actually what you'll end up owing. Tom asked for $40,000 and watched $32,000 land in his account, with $8,000 sent straight to the IRS on his behalf. Depending on his actual tax bracket that year, he'll either get some of that back at filing time or owe a little more on top of it. It's not a penalty, it's just automatic withholding. But if you're budgeting around a specific number hitting your account next month, plan for that 20% haircut now, not as a surprise next April. Now, everything so far has been about the standard rule of 55, but there are 2 more escape hatches worth knowing about. One that's actually better than the rule of 55 for a specific group of people, and a handful of newer exceptions Congress added recently that most creators covering this topic haven't even mentioned yet. If you work for a state or local government, a public school, or a public university, you likely have access to something called a governmental 457B plan, and it plays by a completely different, far more generous set of rules. Distributions from a governmental 457B are not subject to the 10% early withdrawal penalty at any age, period, once you've separated from service. No age 55 threshold to track, no calendar year math to double check, no rollover trap sitting there waiting to catch you. The one catch worth flagging. If you ever rolled money into that 457B from a 401k or an IRA, that specific rolled-in slice keeps its original account's rules attached to it forever. But money that's always lived inside the 457B itself is penalty-free the moment you walk away, at literally any age. If that's you, this single fact is worth more than everything else in this video combined. And if you're not close to 55 yet, or your plan just doesn't support the rule of 55 the way you need it to, Congress opened 4 narrower side doors through the Secure 2.0 Act that are worth knowing exist. An emergency personal expense withdrawal, capped at the lesser of $1,000 or your balance minus $1,000 once every year. A domestic abuse victim withdrawal, capped at the lesser of $10,000 or half your vested balance, self-certified, within a year of the abuse occurring. A terminal illness withdrawal, with no dollar cap at all, if a physician certifies you're reasonably expected to have up to 84 months, 7 years, to live. And a federally declared disaster withdrawal, capped at $22,000 if you lived in the disaster area and suffered a genuine economic loss because of it. Every one of these can be repaid within 3 years if your situation changes. None of them are the main event here, but if the rule of 55 doesn't fit your exact situation, one of these 4 quietly might. So how do you actually use any of this? Not with a guess. With one number. Call it your bridge number. How much money you'd actually need to pull, penalty-free, to get from the day you separate all the way to the day you turn 59 and a half. The day all of this stops mattering because the regular rules already let you in anyway. Here's the formula. Take how much you'd need to withdraw from that account each month to cover the gap and multiply it by the number of months between your separation date and your 59 and a half birthday. Let's run it for Tom. He separated at 54, turns 59 and a half in 42 months, and figured he'd need about $3,000 a month from that old 401k to bridge the gap alongside his other income. $3,000 times 42 months is $126,000. That's Tom's real number, not a guess. A specific target he can check against his actual account balance tonight. Now watch what happens across 3 different situations, because your number almost certainly isn't going to look like Tom's. Someone who only needs $2,000 a month for that same 42-month bridge is looking at $84,000 total. Someone who needs $5,000 a month, maybe supporting a spouse who isn't working yet either, or carrying a mortgage alone for a while, is looking at $210,000 for the exact same bridge window. Same rule, same timeline. Wildly different numbers because your monthly need is the one variable doing all the moving. This is the same kind of math the channel's free Dividend Snowball calculator already walks you through, just pointed at a different question. The description has it, no cost, no email required to look at it first. Just plug in your own numbers instead of doing this by hand on a napkin. Whether the question is, how much dividend income do I need, or how big a bridge do I need before I'm 59 and a half? It's the exact same discipline. Run your own numbers before you decide anything, using them instead of Tom's or mine. Let's pull this whole thing back together, because there was a lot in there and you weren't necessarily giving this your full attention the entire time. That's fine. Here's the short version. The Rule of 55 lets you pull money penalty-free from your most recent employer's 401k or 403 bucks if you separate in or after the calendar year you turn 55. That's the separation year rule. And the year is what counts, not the exact date on the calendar. It only applies to that one specific plan, the one plan rule, not every old account you're carrying around from decades of job hopping. Rolling that money into an IRA before you're certain you won't need it early is the rollover trap, and it becomes permanent the moment the transfer clears. Your specific plan might force a lump sum squeeze instead of letting you take installments on your own schedule, so call and ask before you assume. Whatever you do, Pullout gets an automatic 20% federal withholding taken off the top. If you work in government or public education, your 457B might skip this entire rule and let you out penalty-free at any age, no exception required. And if none of that fits your situation, Secure 2.0's side doors might. Run your own bridge number before you touch a single dollar of it. Tom and Mike walked out of that layoff at the exact same age, with the exact same rules sitting there available to both of them. The only difference between them was one phone call, one advisor's question, asked or not asked, before the paperwork got signed. Tom kept his money right where it was and it cost him nothing. Mike moved his to something better, and it cost him $4,000 he will never get back. The rule didn't fail Mike. The rollover did. You don't have to know which one of those two guys you are yet. You just have to check, before you sign anything, before you roll anything anywhere, whether the account you're about to move still has this door open. If you liked understanding what's actually hiding in your 401k's fine print, the next video you should watch is How to Live Off Dividends Starting at Your 40s or 50s. You're not late, because getting the money out penalty-free is only half the problem. The real question is what you actually do with it once it's out so it lasts as long as you need it to. And that video walks through the exact math for that. And before you go, tell me in the comments, do you know right now, off the top of your head, which calendar year you turn 55? Most people don't. Go check and drop the year below.